Welcome back. Today is March 25th, 2026, and the U.S. economy is at a critical crossroads. Before we dive into the deep details, make sure to subscribe to our channel for daily in-depth economic analysis. From resilient GDP growth to a cooling labor market and oil price spikes, there is a lot to unpack today. The dominant story right now is the military engagement with Iran, which is sending shockwaves through energy markets. Let's start our step-by-step breakdown with Step 1, gross domestic product and the drivers of U.S. growth. Despite a sluggish end to 2025 due to the government shutdown, GDP is showing a surprising early 2026 rebound. The primary engine of this resilience is massive business investment in artificial intelligence infrastructure. Coupled with this is the ongoing resilience of the American consumer, supported by recent tax cuts. Forecasts from S&P Global and Goldman Sachs suggest a steady 2 to 2.5% growth path for 2026. Moving to Step 2, we look at a unique twist in the data: the divergence between PCE and CPI inflation. While CPI is trending lower at 2.4%, the Fed's preferred PCE metric has spiked to 3.1%. The culprit is supercore inflation, services excluding housing and energy, which remains stubbornly high. Recent energy price spikes due to the Middle East conflict are now threatening to push headline inflation even higher. Step 3 focuses on the labor market, which is shifting from tight to what experts call low hire, low fire. The February employment report was a shock, showing a loss of 92,000 jobs. A massive miss. The national unemployment rate has now climbed to 4.4% as long-term joblessness rises. Job losses were broad-based, hitting healthcare, education, and the hospitality sectors particularly hard. Now, Step 4. The Federal Reserve's response to this mix of high inflation and cooling jobs. Chair Jerome Powell has adopted a wait-and-see approach, keeping rates steady between 3.5 and 3.75%. Internal dissent is growing, but the majority of officials now signal only one possible rate cut for the rest of 2026. In Step 5, we see the real-world impact on the housing market, where borrowing costs are surging again. Mortgage rates have climbed back above 7%, causing total applications to plummet by over 10%. The lock-in effect remains severe, as homeowners refuse to trade their low rates for today's high costs, keeping inventory scarce. Moving to Step 6, we examine the growing divide in how Americans are spending their money. Retail sales are forecast to reach $5.6 trillion, but the growth is increasingly driven by high-income households. While tax refunds provide a boost, much of that cash is being absorbed by rising utility and fuel costs. Finally, Step 7. The near-term wildcard that could derail everything: geopolitics. If the conflict in the Middle East continues, we could face a stagflationary environment, high prices and low growth. To summarize, growth is steady, but sticky inflation and high rates are testing the economy's resilience. Thank you for watching. Support us by liking, commenting, and subscribing to stay informed on the U.S. economy.